On the day Iran and the United States declared a ceasefire, 5 ships crossed the Strait of Hormuz. Before the war, that number was between 130 and 160 every single day. That gap is the story of the week. The guns stopped firing, but the economic blockade did not end. Iran's deputy foreign minister confirmed Thursday that any vessel needing to transit the strait must first get army approval, so troops can direct crews around the mines still floating in the water. A ceasefire, technically. A chokehold, practically. The oil market caught on quickly. Brent crude, which fell 13% on Wednesday when the truce was announced, bounced back above $97 Thursday, as traders absorbed what the ceasefire actually covers. Goldman Sachs put the arithmetic bluntly. If the strait stays closed for one more month, Brent averages above $100 for the rest of 2026. If the closure drags on and regional production is disrupted, Goldman's adverse case goes to $120 in the third quarter. That scenario lands on an economy already running hot. The Federal Reserve's preferred inflation gauge, the PCE price index, showed core inflation at 3% in February, exactly where it has been stuck for 3 consecutive months. On a 3-month annualized basis, core PCE is now running at 3.7%, nearly double the Fed's 2% target. And that data does not yet include a single dollar of oil shock. Joseph Brusuelis, chief economist at RSM, summarized the setup with unusual directness. Stagflation was already slightly worse than expected before the first shot was fired in Iran. The parallels to the 1970s are growing, he said, as investors assess a fragile ceasefire. The Fed's problem is structural. Minutes from the March meeting, released Wednesday, showed policymakers worried about both sides of their dual mandate, prices and employment, but unable to move in either direction. One Fed official openly flagged the possibility of a rate hike if gas prices and inflation stay elevated. Chicago Fed President Austin Goolsbee described it precisely. The central bank now faces an oil shock on top of tariff-driven goods inflation that had not yet fully faded. Consumer spending in February rose just 0.5%, below the 0.6% expected, and personal income fell 0.1%, the opposite of the expected 0.4% gain. Fourth quarter GDP was revised down again to 0.5% annualized, the third consecutive downward revision from the initial 1.4% estimate. The ceasefire gives the Fed no relief. If the strait reopens fully and oil retreats, the central bank can resume watching whether tariff-driven goods inflation eventually fades. And services inflation showed some improvement in February, which Evercore ISI's Krishna Guha called a meaningful sigh of relief. But if the Hormuz situation stays unresolved through peace talks that begin Friday, every commodity price that matters to household budgets will be moving against the 2% target simultaneously. The same day oil reclaimed $97, Amazon stock gained more than 5%, its biggest single-session move in 5 months. The catalyst was a letter. Amazon CEO Andy Jassy disclosed for the first time in his annual shareholder letter that AWS is already generating a $15 billion annualized revenue run rate from AI services. He did not bury the number. He used it to answer the question that has been hanging over the entire AI infrastructure trade since 2024. When does $200 billion in capital spending start producing revenue? His answer was now. Of the roughly $200 billion Amazon expects to deploy in 2026, Jassy said, a substantial portion is already backed by customer commitments, much of it scheduled to generate revenue in 2027 and 2028. The Trainium 4 chip, Amazon's in-house AI accelerator, is nearly sold out before broad availability. That last point is what moved the stock beyond simple guidance optimism. Short seller Andrew Left, who has been long Amazon, called the letter a game changer and set a $300 price target, roughly 30% above Thursday's close. His argument was specific. Jassy signaled that enterprise customers are actively moving workloads from NVIDIA-based infrastructure to Amazon's custom silicon, because the price-performance math is changing. Left described Trainium 4 as the most serious threat to NVIDIA's semiconductor dominance ever created. Jassy himself said Amazon will always host NVIDIA workloads, but customers want better price performance, and they are finding it. The infrastructure battle is widening on every front. Meta committed an additional $21 billion to CoreWeave through December 2032. Bringing the total contractual commitment between the two companies to $35.2 billion. CoreWeave's total revenue backlog now stands at $66.8 billion, representing 342% growth from the start of 2025. For context, CoreWeave guided 2026 revenues to between $12 billion and $13 billion. growth of 134 to 153% year-over-year, against AWS growing 17% and Azure growing 31%. On the same day, Google confirmed a multi-generation commitment to Intel's Xeon processors for AI training and inference workloads in its data centers. Intel shares gained 5% on the news. The architecture of AI compute is fracturing. NVIDIA dominated the first wave by being the only scaled option. The second wave is producing alternatives. Amazon's Trainium, Intel's Xeon refresh backed by government investment and NVIDIA equity, and hyperscaler-specific chips at Meta and Google. CoreWeave's $21 billion Meta deal explicitly includes early deployment of NVIDIA's next-generation Vera Rubin platform, which has not yet been broadly released. That means CoreWeave benefits from both sides of the transition. The risk inside this trade is capital intensity. CoreWeave carried $21 billion in long-term debt at year-end 2025, up from $14 billion 3 months earlier. It simultaneously filed for a $3 billion convertible note offering Thursday. Free cash flow is deeply negative, and the company spends $2.60 in capex for every $1 of new revenue in 2026. The saving grace is timing. No debt matures until 2029, and contracted backlog covers revenue visibility through the decade. If AI demand growth moderates before CoreWeave's capital structure stabilizes, that backlog visibility becomes the only thing standing between the company and a refinancing crisis. The broader AI labor story adds another layer. Goldman Sachs published analysis Thursday showing AI is eliminating roughly 16,000 net jobs per month in the United States. 25,000 substituted out, 9,000 new roles created. The displacement is concentrated in entry-level white-collar work, hitting workers under 30 the hardest. That matters for the macro picture. If AI productivity gains are real but distributed unevenly, consumer spending pressure compounds the existing drag from energy prices and weak income growth. The two dominant forces in markets right now are moving in opposite directions. The energy and geopolitical complex, oil above $97, Fed paralyzed, GDP revised down to 0.5%, argues for caution and defensive-ness. The AI infrastructure build-out, Amazon at $15 billion AI run rate, CoreWeave backlogged to $66.8 billion. Intel winning multi-decade data center commitments, argues that enterprise technology spending is accelerating through the uncertainty, not retreating from it. The weight of evidence leans toward continued AI infrastructure momentum holding in the near term, driven by locked-in customer commitments that predate the Iran war and cannot easily be unwound. But that leaning holds only if two conditions stay intact. First, that the Hormuz ceasefire converts into actual flows within the next 2 weeks, bringing oil back below $90 and releasing the Fed from rate hike pressure. Second, that March CPI, due Friday, does not come in above the consensus of 3.3% headline, which would force a reassessment of how much the energy shock has already passed through to broader prices. If headline CPI prints above 3.5%, the stagflation framing hardens, equity multiples compress, and even contracted AI backlogs cannot insulate growth stocks from a repricing. Watch the Hormuz ship count this weekend. If flows reach the promised minimum of 15 vessels per day, oil retreats and the Fed's optionality is restored. If the count stays in single digits, Goldman's $100 plus scenario for the second half becomes the base case, and the Fed official who raised a rate hike is no longer a dissenting voice.